online event. My name is Eric Coltrane, and I'm a director for the People for Effective Government, or PEG for short. Thank you for joining us tonight. PEG is a nonprofit, Spokane-based, nonpartisan coalition. Our mission is to support bipartisan approaches to governing, which are fiscally responsible, ensure an adequate social safety net, and promote a civil society. We've been holding in-person forums and online events since spring of 2018. The members of PEG are committed to changing the current political climate, which our two major parties have become increasingly polarized. Through these forums, we are working to encourage sincere and civil debate about the challenges that our nation faces and about effective solutions to those challenges. If you're finding these events helpful, please consider joining as a member or making a donation to PEG. We're a 501c3 nonprofit relying on membership dues and donations to cover costs. Please visit our website at www.pegnow.org. This event is being recorded and will be posted on our website in a week or two. As always, the views presented by our guest speakers are their own. As a nonprofit, PEG neither participates in political campaigns on behalf of or in opposition to any candidate for public office, nor engages in political activity of any kind. Our audience is encouraged to submit questions for our speaker using the Zoom Q&A feature. Please keep them brief so we can get to as many questions as possible. It is an honor to introduce our speaker for the evening. Dr. Grant Forsyth is the Chief Economist of Avista Corp. Before coming to Avista in 2012, he was a professor of economics at Eastern Washington University from 1999 to 2012. From 1996 to 1999, he worked in the Czech Republic as an academic and private sector economist. He received an MBA in economics from Central Washington University. I might have messed that up. Correct that.
Close enough.
His MBA in finance from the University of Oregon and his PhD in economics from Washington State University. He also serves on the Washington Governor's Council of Economic Advisors, the Citizen Commission for the Performance Measurement of Tax Preferences, and the Spokane Mayor's Economic Advisory Roundtable. Thank you, Dr. Forsyth, for again participating in one of our forums. We value your perspective and expertise. Please take it away, and we'll do questions after your presentation.
Well, good evening, everybody. If you'll just give me a minute here, I need to set up my screen. Okay, now hopefully everybody can hear me. Can just do a quick test. Can you see my screen and can you hear me?
You can.
Okay, great. So what I was asked to do this time, this is very different than the presentation I gave about a year ago when I was talking about my experiences in the Czech Republic. This is really looking at the impact of COVID-19. And what I was asked to talk about was really what does the economic data and research say about the economic impacts of COVID-19? And this is actually a pretty good topic because we're starting to see now a wave of research and data come out about kind of what the impacts have been from COVID and what might be some of the longer term implications of the pandemic. And so that's what we're going to really focus on this evening. Now, memes are very popular right now, and this is one of my favorite because it kind of captures the essence of the problem we have is, are you happy? And the question is, well, if by happy you mean trapped with no means of escape, then yes, I'm happy. I mean, the reality is, the only way we're going to kind of get back to any sense of normality is really with a vaccine. And as it happens, we now have 2 good candidates. We could possibly have 3. But ultimately, to get back to any kind of normal environment, economists are now in agreement that it's that vaccine that's really going to get us there. Okay. With that being said, though, let's talk a little bit about what we know about COVID impacts and kind of talking about the basic conclusions we're going to find as I go through the presentation. So I'm really going to tell you from the beginning what we're going to see. Right? There's mounting evidence that we're going to see an accelerating shift of global output to Asia. In other words, a shifting share of global GDP to Asia, and that's accelerating because Asia has probably handled this pandemic better than the more advanced countries. We're seeing a weak employment recovery and ongoing fiscal and monetary support, right? That's probably going to be in place for quite some time, and we'll talk about why that is. We are seeing that low wage, low skilled workers were hit hard. We're also seeing that women workers and women business owners have also been hit hard by this pandemic. We're also probably going to end up seeing the depressed wages for new workers starting during the pandemic. And this would be in particular young people coming out of school, in particular college, and starting work at the time of the pandemic. We're also going to very likely see changes in wealth inequality in many countries. In particular, the US, there's some good reasons to think we might see more inequality, and we'll talk about why that might be. And we might also see a potential accelerated shift to labor reducing technologies. And again, we'll spend some time talking about that based on some research that came out pre-pandemic. So let's talk about GDP and the shift towards Asia. And so what I'm showing you here in this graph is the forecast for annual GDP growth from 2020 to 2025 produced by the IMF, the International Monetary Fund. And we can see here United States, Europe, Asia and Pacific as a region, the advanced economies as a region, which would of course include the US, emerging market and developing economies, and then the world as a whole. Okay. So I want to focus on that middle part first, the Asia and Pacific and advanced economies. And what you can really kind of clearly see, if you look at the outlook for GDP growth from the IMF, why you're going to see a shift, an accelerating shift of global GDP, that increasing share is going to be in Asia, right? In particular, if you look at that red bar, which is this year, the downturn is much less severe than what you're seeing in advanced economies. And the outlook for future growth is much stronger than what you're seeing in advanced economies. And really this reflects the fact, quite frankly, that the Asia Pacific region has really done a better job of controlling COVID-19, which means their downturn was less severe and their recovery has been maybe a bit more robust, or is expected to be more robust. Okay. Now, when we think about the advanced economies, you can see there at the beginning, we've got the United States and Europe. Okay. And this is really dragging down the all advanced economies because that's where most of them are, is the United States and Europe. And you can see in particular, Europe is really had a very tough time dealing with COVID. They've had a very severe downturn. So the forecast for 2020 is probably going to be pretty close to what actually is. That is around -7, -8%, which is a huge downturn. The problem for Europe is that there's some growing evidence that they could end up having a double dip, meaning a second, maybe minor recession in 2021 if they can't get the virus under control and get that vaccine distributed more effectively. If we focus on the US, actually, as it turns out this year, we probably won't be as low as -4%. When COVID first hit, the expectation for the United States was we were going to be similar to Europe, around -7 or -8%. But what I think is going to happen when we get the fourth quarter GDP numbers in a couple of days will probably be more like -3% this year. The expectation is we'll have a pretty good rebound effect, maybe over 3% in 2021, but it's still the case that the outlook for growth overall is pretty modest for both the United States and Europe relative to Asia and the Pacific region, which means we're just going to see an accelerating shift of output activity to that Asian region. So I think that's one of the longer term things we're going to observe is that accelerating shift. Okay. Now, this next graph kind of shows One of the problems we're having though in our recovery, and why people are now a little bit worried about the first quarter of this year, because what we're seeing is really a stalling in employment recovery, and we're also seeing this in Europe. So what this graph shows is it's the level of employment indexed to February 2020, which was the last period of normality we had before we began the shutdown process in the United States. So again, the base here is the employment level in February 2020, and then we compare that to against all future employment levels going out to December 2020. And what you can see is that after an initial bounce back when we reopened starting in June, really the employment level, that index number really hasn't changed much since July. And that reflects this kind of stalling recovery process, okay, both in the US and Europe. So what this really means is long term is that central banks in the US and Europe and other advanced countries are going to have to remain very accommodative, keeping interest rates exceptionally low for a prolonged period of time. The current expectation of the US Federal Reserve is that we're not going to return back to kind of normal levels of activity in terms of unemployment and so forth, maybe until 2023. Okay. So really the only thing that's going to kind of get this recovery going again is, again, central banks need to remain accommodative. We need some additional fiscal stimulus, which we're getting through this second stimulus package, maybe a third one too. We're not sure yet. But again, the key thing ultimately is getting these vaccines out and distributed. But again, a point of concern here for the advanced countries is the stalling recovery on the employment side. And in fact, it's the labor market distortions that are causing the greatest concern. And we'll see that as we go through the slides this evening. So before we get to kind of some of the research, I also wanted to talk about inflation because everybody's concerned about inflation again. The outlook for inflation is actually not that severe. I mean, a lot of people are concerned that because you have a highly accommodative monetary policy, highly accommodative fiscal policy, that we're going to be entering a period of rapidly rising inflation in the United States and Europe. But that's certainly not the outlook from the IMF, and certainly not the outlook from a lot of economists, including this one. Okay, now it's interesting, the IMF expects inflation to actually jump up to over 2.5% consumer inflation in 2021. I don't necessarily see that. I think other forecasters are less sure. If you look at a broader range of forecasts than just the IMF, most people see an anchored 2% inflation rate really out through 2025, meaning that they feel pretty comfortable that the Fed is going to be able to keep inflation around that 2% target. Europe is also going to struggle to keep inflation around a 2% target. You know, you do see higher inflation in Asia and Pacific regions, emerging markets, but that really reflects pretty robust growth more than it does out of control monetary policy or spending. Okay. And what it's important to recognize, and we had a brief conversation about this before the presentation started with a couple of people, is that if you're old enough, and I'm 55, you can remember a period where inflation was actually much, much higher than what we have now. If you look at global inflation in the 1980 to 1995 period, the world inflation rate, okay, calculated by the IMF, was about 20% per year during that period, right? And so we're actually a long ways from that kind of inflation. And the truth is there's been so much demand destruction because of the pandemic. I don't really necessarily see the accommodative monetary and fiscal policy being as inflationary as some people may be concerned about. Okay, so with that, let's talk a little bit more about what the research is showing that what the research is showing about some of the impacts of COVID, but also the impacts of some policies that came out because of COVID. And again, I want to talk a little bit about the CARES Act. Now, we've had CARES 1, that was the original one, and then we have another CARES. They've re-extended that program. And if you remember, CARES payments are essentially direct cash payments to households. And so this particular research was done by the National Bureau of Economic Research, the NBER. It's a nonpartisan think tank. It's best known as the organization that dates our expansions and contractions, but they also produce a lot of new cutting edge research through the NBER by allowing faculty members from all over the world to initially publish their research through the NBER. This particular research paper, it was called How Did US Consumers Use Their Stimulus Payments? And they went out and they surveyed 12,000 respondents, essentially 12,000 households. And they asked, how was your money used? And if you remember, the original payment was $1,200 plus some additional money if you had dependents. And they basically asked the question, how did you use the money? And so that chart is really on the right. It's 12,000 survey respondents. And as it turns out, people use their CARES payments actually very judiciously. I mean, if you look at the way they use their payments, I think one could argue that the response of the CARES Act was uh, highly successful. Okay, and so in particular, what they found is that really about 40% of the CARES payments was spent on non-debt spending, and that was mostly non-durable. So people didn't go out and buy things like boats and jet skis and all this kind of thing. Really, what they did is they increased their spending on the types of things you would want in your household as being part of a pandemic. I mean, you're at home more, you have more toilet paper, more food, this kind of thing. And that's really where a lot of the money went, was to non-durable spending. But interestingly, a lot of households, okay, clearly they use 30% of that money to pay down debt. Now, I think that's very useful to know that, because what that means is these carrots payments probably greatly reduce the likelihood of a debt repayment crisis, which you probably don't want at the same time you're having a pandemic. The other interesting finding was that 30% of it was saved. Now, what they did find is that 30% saved, it's an average, right? And higher income people tended to save more than low income people. But people did set aside some of that money, which is important, because what it means is they have a little bit of surplus to live off of, pay bills off of, as the pandemic is spread out over time, and as Congress basically negotiates and fights until they come up with a second plan. But the results here suggest that households actually used their CARES payments in a very responsible way, and in a way that probably kept the economy from going much lower. Now, the concern about this, of course, was that many people were worried that all these CARES payments and extended unemployment benefits would cause people not to want to work. As it turns out, there's really no evidence that these payments in the long run are going to cause people not to want to return to work. And so there's some thinking that it makes some sense to extend these programs, again, to keep the economy, as it starts to stall, from getting much worse. So in effect, these programs have been pretty successful. Now, other NBER research that I think is highly useful in thinking about kind of the long-term impacts of the pandemic is looking at, again, employment impacts. And so this particular study from the NBER used ADP data. Now, some of you may be familiar with this data. This is ADP is a company that does payroll processing, and they have their own data on non-farm employment in the US. And it's often released just prior, maybe a week or so before the official Bureau of Labor Statistics data is released on non-farm employment. So it's kind of an early indicator. So some researchers worked with the ADP, took their data, and looked at what was the employment change if you break it out by firm size. So we can see what the overall decline in employment is, but it's also important to look at it. Did it matter in terms of the size of your firm, in terms of the number of employees you had? And it turns out it did, is that at least initially, smaller firms took the biggest hit in terms of letting people go compared to larger firms. Now, as we're going to talk about again a little bit later, some of these other topics, research came out this week looking at NBER, again, National Bureau of Economic Research, looking at, instead of looking at employment, what was the impact on revenue based on different characteristics? So here's where it's really interesting. Okay, they looked at online versus offline businesses. These are firms that either have an online business or they're brick and mortar only. It turns out that if you were an offline business, you had much larger revenue declines than online businesses. And the larger you are as an online business, the more successful you were in negotiating the pandemic. Okay. Turns out that if you are a woman or minority owned business, you had significantly bigger declines in your revenue as a business owner than say male owned or non-minority owned businesses. Particularly interesting, they also found out that your degree status as an owner mattered a lot too. So it turns out that if you were a business owner with a humanities degree, you experienced a much bigger decline in revenue than if you had a STEM degree, like an engineering degree or a mathematics degree, and you were a business owner. So it turns out degree status was also important. Now, part of that reflects gender differences. Okay, so for example, the majority of people with STEM degrees or STEM backgrounds are men. So there's definitely, in terms of degree status, some division there between men and women. Right? So what the pandemic has shown is that there are some pretty big differences in the employment change by firm size, but also in revenue by different characteristics. Now, it turns out that employment change also matters in terms of how you're paid as a worker. So the most disturbing thing, and this has some big implications for inequality in the United States, are the people that lost the most jobs were the lowest paid workers. And so that's that second graph there. And what it shows you is the employment decline based on the quintile of wage that you fell under. So the lowest quintile means the lowest paid, that's that dark blue line. And then that dark, almost black line is the highest quintile, that's the highest paid workers. And what we see here through the ADP data is the workers who paid the biggest price are those low paid workers. Now keep in mind, pay is often a proxy for skill. So what we see in this pandemic in the long term is some real struggles for low paid, low skilled workers because they took the hardest hit, okay, and from a pay perspective. Now, going forward, we're going to talk about some of these issues a little bit more because as it turns out, there's some other data that can verify what's happened to low wage workers. And I just want to point this out. This is a this is a great data source. They do their own graphing. It's a really kind of a cool website. And it's called Opportunity Insights, and it's their economic tracker. And it's a partnership of Harvard University, Brown University, and the Bill and Melinda Gates Foundation. And what they've done is they've reached out to businesses that have their own proprietary data on business and employment activities and are working with these businesses to bring this high frequency data, it's oftentimes daily or weekly data, to bringing this into analytics so we can see through different data sets than we would normally look at what's been happening to employment and other kinds of activities because of the COVID crisis. Okay. So what this graph is showing you, okay, using again data from different companies, and this is not ADP, this is a different set of companies providing employment data to the Opportunity Insights partnership, okay, we see a verification of what the ADP data is showing us in terms of impacts on people based on their wage. Okay, so the red line really shows you the employment impact looking at high wage individuals. These are people making more than $60,000 a year. Then you have middle wage, which is 27 to 60, and then low wage are people under $27,000 a year. Okay. Now that dotted line is a projection based on partial data. Okay, and the solid line is based on full data that they have, and this carries us basically through the beginning of December. Okay, and what we have here is really a pretty strong verification using high frequency data that really this pandemic has been very hard on low paid workers. Okay. Now, again, that, as we're going to talk about, that poses some real problems because what it may mean is kind of shifting inequality. Okay. Meaning that as we go forward, the United States will see a more unequal distribution of wealth, in part because the lowest paid workers who were already struggling before are the ones paying kind of the highest price in this pandemic. And keep in mind, some of that probably reflects the type of jobs they're in, the type of jobs that would have been severely dampened as a result of the pandemic, leisure and hospitality, that kind of thing. Okay. Now, the other thing to keep in mind here as we're looking at this slide is there's some research that was done last year, pre-pandemic, from the U.S. Census Bureau. And it's really quite interesting research, and it has a direct application to the pandemic. And so what the research shows is that if you're coming out of college and you're starting your career, okay, the state of the economy when you start your career, right, has a big impact on your lifetime earnings, right? And so one of the things that they found is they went back and looked at the Great Recession and looked at people who graduated into the Great Recession and started their employment history in the Great Recession compared to other people who did not start in a recession. And what's pretty clear from the research is that when you come into the labor force during a recession, you have a prolonged depression in your wages compared to if you had not come into a recession. So one of the things that we're going to struggle with is not only how to get low wage workers back on track, but how do we get new college graduates back onto a normal earning path, given the fact that they have come into the labor market in a pandemic, and the research clearly shows they're likely to have a decade, maybe longer, of severely depressed wages as a result of that. Because the theory is that when you start into the labor market during a recession, you'll take any job, even if it's a low paid job. And that has implications for a decade or more in terms of your overall pay and standard of living. And so my guess is one of the long-term effects of this is we're going to have a lot of low-paid workers who never fully recover, and we're going to have a lot of college graduates that are going to struggle to recover given the fact that they started their careers in a severe recession created by the pandemic. Now with that, let me just take a quick break and see if there's any questions at the moment. Okay.
We're gonna hold our questions till the end, probably.
Okay, that's fine. I just wanted to make sure.
Sure.
I would have felt embarrassed if I realized I was talking to myself because of a technical problem. So let's talk about a little bit different way to look at this data. Okay, and again, this is Opportunity Insights, and I strongly encourage you to go look at this website. It's extremely useful. Okay, so what they did is they contacted and worked with a business called Womply, which I'd never heard before, which I think is an interesting name. But Womply provides business services to small business. And I looked on their website, and if I'm interpreting the data they provide about their customers, probably the average annual revenue of their customers is around $250,000 a year. So these are truly small businesses. And so what they're doing is they're working with Womply to see, using Womply data, okay, what's the percentage change of the number of small businesses that are open, okay? And you can see here, we've divided this up into 3 categories, and it's based on zip code. So the green is a low income zip code, the blue is all zip codes, and the red is high income zip code. So we're looking at, the change in the number of businesses open at a high frequency basis by zip code. I find this extremely interesting because what it shows is you had significantly more business closures. I mean, the contraction in open businesses was much larger in high income zip codes than it was in low income zip codes. Now, that seems counterintuitive because you would maybe think that because of a low income zip code, you would see more businesses close as people spend less. But as it turns out, there's an interesting thing that's starting to emerge, and that is that really the only people in the country that have really a significant leeway to save more are the wealthy. And so the argument is one of the reasons you had more business closures in high income zip codes is because it was the wealthy who decided to do a lot more precautionary savings. Low income people don't really have as much leeway to do precautionary savings, that is, savings to protect yourself against the future, because they don't have very much income to begin with. And so it just simply means the bigger contraction in spending because of savings occurred in high income zip codes. And so that meant businesses serving those zip codes took the bigger hit. Now, I think that's really kind of interesting. But I will say that that is actually somewhat consistent, as I think about it, with some research. A colleague of mine who's now retired at Eastern, Dr. David Bunting, he did many years of research on savings. And his conclusion was is that in the United States, the only group of households in the United States that does a lot of savings are the top 20% of households in terms of income. The other 80% either don't do very much savings or they have essentially negative savings, zero or negative. And it's really that top 20% that has that ability to move their savings around. But what that also means is for businesses who are serving those high income households, they may be more susceptible to downturns because those people can move their savings so much in one direction or the next because they have the surplus to do it. And so one of the things going forward is that maybe the recovery in um, in businesses in these high income areas are going to be really dependent on how high income people behave as the economy improves. But I just think that's very worthwhile to point out. And again, going back to Dr. Bunting's research, the other thing he pointed out is that anytime you see the savings rate in the US go up or down, he said because it's really the top 20% of people who are saving, it really reflects their behavior more than the behavior of the other 80%. Now, of course, all of this, all of these employment impacts have some interesting implications for inequality, especially since if you think carefully about it, it's very odd environment because we've had this very deep downturn. There's a lot of people who have been either thrown out of work or they're only working part-time when they need to work full-time. But at the same time, the S&P 500 in 2020 was up 11% based on the average index in 2019 versus the average index number for 2020, right? And so a lot of people have pointed out that if you have any kind of wealth in the form of shares, right, it means that you're going to have this weird kind of distortion where wealthy people with assets might end up doing relatively well. So you're a wealthy person, you're well educated, which means you were probably a bit more insulated from the employment decline. And at the same time, you own financial assets which have done relatively well. So what that just means is the wealth of the country just continues to shift more in your favor, right? And so if we look at the first graph there, what this is showing is the share of equities and mutual funds owned by the top 1% in terms of their wealth. So if you look at the wealthiest 1% in the United States, you can see the difference between 1989 and 2020. And I use the third quarter because that's the most recent data. And 1989 is the earliest I can go back. This is Federal Reserve data. And you can see what a big shift there's actually been in the top 1%. So you go from 43% of essentially share ownership, right, for the wealthiest 1% to 53% by the third quarter of 2020. Okay. And so the concern is that we're going to see a continuing shift towards that top 1% because that's who owns the equities and the equities are doing pretty well, right? And if you actually look at the top 10%, right, the top 10%, okay, that's the top 1% and then the next 9%, they own like 90% of the share and mutual fund shares in the United States. The remaining, all other households, the other 90%, currently only own 12%. Okay. And so the concern here is that in the long run, we're just going to get a more skewed distribution of wealth within the United States because it's those wealthiest households that have been able to weather it, the employment impacts the best, but they also own the shares that have done the best in the pandemic. Now, what also was interesting is that we might also continue to see a shift, and this is another way to look at it, in terms of educational level. And so again, if you look at the share of equities and mutual fund shares owned by level of education, okay, 83% are owned by college educated, okay? And then it drops off radically from there. And if you were to look at this by race, okay, what we're likely to see going forward is a shift towards white college educated households in terms of who benefits through the pandemic with this, pretty robust asset price gains. Right? And so again, we see this continuing shift to the top 10%, especially the top 1% in terms of asset gains. And if you break it out by education, we're really seeing a shift towards white college educated households. And we may see, coming out of the pandemic, that 83% is maybe a bit higher. So what we need to be careful with though is that we need some time to analyze this. I know a lot of people worry about inequality, but we just need to have a little bit more time to go by, a few more years, to get a full picture of how inequality was impacted by COVID. Now, if we look internationally, okay, and this actually comes out of Finance and Development, which is a magazine of the International Monetary Fund, and it's called Disparities in Real Time. And again, it's trying to put together a little bit higher frequency data. Now, what these graphs are showing you is aggregate, it's an aggregate data for a whole bunch of advanced countries, including the United States. So we're really looking more globally now. And really, if you look at the first chart, okay, it's just looking at job postings, and you can see that big decline in job postings over the months that they show relative to 2018 and 2019. And again, what this shows is what we're experiencing in the United States is really a global problem. And so again, when we think about this struggle of college graduates coming out, this is going to be a problem not just in the United States, it's going to be a problem for advanced countries of, how do we get those people back on a track where their wages aren't permanently depressed or depressed for a decade or more simply because of when they came out of school. That's going to be a challenge. Okay, gender gap. Okay, again, what this is showing in the advanced world, right? This is posting for jobs with higher female representation, right? And so what you can see is that women bore the brunt of the job losses. Says jobs with high female participation lost more jobs than jobs with low female participation. Okay, and this is really coined the term the she session. Okay, meaning that this particular pandemic, okay, and the recession it created is disproportionately affecting what we would think of as sort of women, but in particular, low income, low skilled women, and I think have taken a particularly large hit, again, not just in the United States, but globally. Now, this next bit of research, this really looks at, again, a longer term trend. And one of the things that people have raised the issue of is how does the pandemic maybe affect the way companies use technology to reduce their dependency on labor? Because technology can't get sick with an actual, the COVID-19, right? And so the idea is this going to accelerate or change the way firms think about using technology? Now, this is important because this is a paper that was written just a couple of years ago, again, pre-pandemic. And what it really shows is how technology is changing the labor share of output. Okay? And this is for the United States. And so when we think of GDP or output, we think of that as stuff being made. but we can also think of output because it's sold as income. And so what the study really is looking at is what is the labor share of income that's generated when we produce something? Because when a firm produces something, they have to pay labor out of that process. Okay. And what they showed is from 1947 to 1987, okay, was that there's two effects. There's the reinstatement effect of technical innovation, and there's a displacement effect. The displacement effect reflects, loss, essentially losing labor share because you have technology where you need less labor. The reinstatement effect is where you have technical innovation that actually kind of increases the demand for labor in some way. And from 1947 to 1987, they balanced each other. So the labor share of output, labor share of national income was relatively unchanged for a long time. When we get to the 1987, late 1980s, early 1990s, and they look at the same data, they're looking at that displacement effect versus the reinstatement effect. What they're finding now is the displacement effect is outweighing the reinstatement effect, so that labor share or labor's importance in the production process has actually declined starting in the late 1980s. And this in part reflects the type of technical innovation that firms now have access to. And so the uncertainty is that as we move forward, will firms continue to adopt technical innovation where there's a big displacement effect because that innovation is less susceptible to illness? So one of the things we can observe or could observe, and then one of the things we're going to pay attention to is whether or not that displacement effect gets larger as a result of the pandemic as firms try to adjust to the potential that this could happen again. Excuse me. Now with that really takes us to where we started. Okay, so again, we have this shifting share of global GDP to Asia, this acceleration because of the pandemic, because Asia has probably handled the pandemic better. We have this weak employment recovery and ongoing fiscal and monetary support, which is important because the evidence suggests it's needed and it has worked well, as we saw with the CARES research. We're going to have a hard time getting low wage, low skilled workers to fully recover from this because they've been hit pretty hard. It's the same for women workers and business owners, and minority business owners have been hit hard. They're probably going to struggle the most to recover in the long run. We're going to have a prolonged period probably of depressed wages for new workers who started during the pandemic, and that's both in the US and other countries as well. We've got the potential for a change in wealth inequality in many countries, the US. We need a bit more time to study this, but right now it looks like we could see that given what we've seen with asset prices and who holds those assets. And again, this has the potential to accelerate the shift to labor reducing technologies as firms again try to insulate themselves from this kind of event again in the future. So with that, I'm going to go ahead and stop and just kind of leave it open for whatever broad range of questions you might have.
Great. Really appreciate it, Dr. Forsyth. A lot of good graphs there. I might ask you to flip back to a few.
You bet.
Good stuff here. So I think I want to start. It seems clear that the pandemic has the potential to exacerbate wealth inequality. Is that fair to assume?
Right.
So I'm curious, one of the big topics right now is what do we do about student debt? And
Yes.
there are proposals to cancel student debt. But one of the graphs you showed, you might be able to go back and look at it, shows that the college educated or the higher educated are doing better relative to the less educated.
Right.
What do you think the impact would be of canceling student debt, given that it seems that the better educated are doing better than the less educated?
Well, okay, there's, yeah, this is a tough question. First off, canceling college debt has a big problem, is it has a moral hazard problem. Because if you cancel it for one generation of college students, what happens down the road, right? I mean, is there expectation then at some point that we're just going to recancel the debt uh, in a future way? So in other words, if you recancel it for one group of students, I mean, and in a few more years, do you just recancel it or cancel it again for another group? That poses some real problems for how that debt market is supposed to function. Uh, to me, the missing element of talking about how you handle the cost of higher education is we're focused on debt and trying to find some way to cancel the debt, but nobody's talking about how to change or lower the cost of college education. I mean, nobody's really talking about the cost side. And it seems to me that if you're really going to talk about reforming higher ed in a way that you have fewer debt problems in the future, uh, you have to talk about the cost side. Because if you don't talk about the cost side, you're going to be in this again, you're going to be in the situation of recanceling debt again in the future. Maybe we don't want to go that way. Maybe we ought to think about a way of restructuring higher ed, especially public higher ed, where there's an emphasis on better cost management.
Thank you. So, and you also talked about the fact that the pandemic has been harder on the whole on females.
Yes.
So Axios, reading from an Axios article
Hmm.
in the last week or so, and it says the Biden administration economic policy team has signaled that it will be the first administration ever to construct economic policy around issues like race, gender equality, and climate change, rather than around traditional indicators like gross domestic product or deficit
Hmm.
ratio. What do you think they mean by that? And do you think it's a good idea?
Yeah, this is, that's actually a great question, and it's complicated because, for many, I mean, economists have long known there are some deficiencies in using things like GDP or GDP per capita as the only measure of progress. Um, and so, now that we've got a lot more data, I mean, we do have an incredible amount of data that's available out there. A lot of it's, as we've seen, kind of higher frequency data. I mean, to me, it does make sense to look not only at those traditional measures, how they progress, but at the same time to look at these other measures like, you know, uh, you know, racial progress, in terms of income and that kind of thing, to measure those at the same time. So you want to look at both. And I would just point out that it's important that you not give up on economic growth though, and focusing on economic growth, because it's the economic growth that gives you the money, I should say, it gives you the base to fund these other programs that will help solve some of these inequality issues. I sometimes worry that we're going to become so focused on solving things like inequality and some of these other problems that we're going to stop worrying about growth. But it's economic growth that helps you pay for things without necessarily having to raise taxes rapidly. And so I just think there needs to be a balance. I mean, we got to look at both. We've got a lot of good data now to look at both, but we just need to make sure that we're not moving away from the importance of economic growth in terms of paying for programs that could help solve these other problems.
Thank you. And Jenny, I'm going to ask one more question, but I am having a weird screen issue here, so I cannot see the audience questions. But I'm going to ask one more, and if you're listening, maybe you could ask the next one.
I will. Thanks.
Yeah. So you mentioned that low-skilled workers have been the hardest hit by this, obviously, right? So you had a number of charts on that. What do you think? What do you think a higher minimum wage mean for that problem? Right? Does a higher minimum wage mitigate that problem, or does it exacerbate that problem? Do you believe?
Yeah, that's another good question. I mean, it depends on how high you go with the minimum wage. I mean, there is a point where if you increase the minimum wage too much, too rapidly, people will substitute away from labor. And what you'll end up with is a smaller pool of jobs available to people who have low skills. Because remember, a low wage, that tends to be associated with your skill level. And so it seems to me one of the ways to help improve um, a person's wage potential. I mean, I'm not opposed to a minimum wage. I just think you have to be careful how aggressively you use a minimum wage. I think the real answer lies in what is the training available to people who currently have low wage, low skilled jobs, so they have the ability to step up to jobs that have higher pay and a bit more resistance to, economic shocks. Right? And so to me, if you're going to talk about the situation that these low wage people find themselves in, you need to talk about their skill level and how you help them improve that so they've got a broader range of jobs that are open to them.
Thank you.
And that I have to say that goes right back to the cost of it, getting an advanced education, right? So I think for a lot of people who might be in low skilled, low wage jobs, I mean, the prospect of going to college, I mean, look very positive to them. But if they're also looking at the debt accumulation that occurs with this is, an even, I think, a bigger excuse to look at what are the cost drivers in higher ed and what can we do to get them under control? Because again, that gives low wage people maybe a bit more incentive to get that advanced education if they don't run the risk of a debt problem down the road.
It does seem, this is just coming from me, that the debate around higher ed is mostly about who pays, not about the cost.
Right. And furthermore, and again, a colleague of mine has pointed out to me that there's some research to indicate the way the student loan market is managed. That in itself may be causing some of the cost escalation. So maybe we ought to rethink of instead of forgiving debt per se, automatically, maybe we ought to rethink of how that loan market functions. And is that contributing to some of the cost escalations?
Sure. Jenny, do you have an audience question?
I do. I have a few. And I have a question from one of our audience members about this specific issue, and I'm just going to ask it
Mm-hmm.
and let you, Grant, add to it if you think that that would help.
Okay.
And the question is, the moral hazard argument is essentially philosophical. Is there data over time that bears it out?
Well, yeah, I mean, a little bit. I mean, I think if you look at debt forgiveness in other countries, you can look at countries like Argentina and so forth. There is this tendency to, so again, using the example of loans to developing countries, there is some evidence to suggest that if you give loans to countries, they get into trouble, you have debt forgiveness, and then over time they end up in that same situation again, and you're back to, okay, we've got to give them, maybe think about debt forgiveness again. So there's a little bit of history on loans to emerging or developing worlds where automatic forgiveness does maybe lead to the expectation is that if they get themselves in trouble again, they can do that. And maybe in the case of the student loan market, maybe there are reasons to think it might be different, but I still think if you don't address the cost issue, which is behind the high debt problem, you're not really fixing you're not fully fixing the problem, is what I would say.
Okay, thank you.
And
Eric,
and let me just throw one more thing in it. If you forgive debt, then the question is, where does that leave the people who lend the money? And if it happens enough, maybe they just simply stop participating in that market.
thank you. Eric, did you want to ask any, or should I keep going?
Ask one more and then I'm going to get on another thing. So,
Okay. Dr. Forsyth, is there any organized effort among economists to promote a fairer economy across the workforce?
It depends. I mean, yeah, I mean, there are definitely economists, I would say, maybe left of center think tanks that are that are looking at this issue and thinking about policies that might bring better equality, or reduce that income inequality problem that we're seeing. It just sort of varies. I wouldn't say that there's a unanimous agreement across economists about what should be done. And part of it, part of it's philosophical about, how much intervention should there be in the economy from the government to try to solve these problems.
Okay.
But
Thank
it's
you.
not, there's not like a monolithic view about how these problems should be addressed.
Thank you. Eric?
Yeah, I'm not sure how to attack this, but I want to get at the heart of the loss of good paying working class blue collar jobs. Right. This week, President Biden signed an executive order nixing the Keystone Pipeline, and maybe that needed to happen. But what do you think the government's responsibility is, and when it has to make, for the public good, it has to make that decision, and helping these people find new work, or more like, what do you think about a massive infrastructure bill? Massive. What do you think the economic benefit, or do you think the benefits outweigh the concerns with a massive infrastructure bill to maybe help get us out of this pandemic?
Well, there's a couple different layers to that. So let me first talk about blue collar jobs a little bit. And this goes back to my last slide. We've lost some blue collar jobs because of firm relocations, moving to regions of the world where labor costs are significantly lower. So there's that element to it. And do we need to review US policy? Are we subsidizing that behavior in some way where we maybe shouldn't? Okay. So is there something in the tax code, or is there something else that we're doing that provides an incentive for firms to leave? Now, we addressed some of that with the cut in corporate taxation. I think in the long run, I think that was, my personal view was, it was controversial, but our corporate tax rate was really kind of out of line with a lot of other countries we're competing against. And so looking at those kinds of policies may help us retain work in the United States. But a big part of blue collar job losses, and this goes to that slide I showed earlier, is simply changes in technical innovation. It's labor replacing technology that's come about that firms have a big incentive to adopt. And that helps explain, I think to some extent, why you have many fewer blue collar jobs in some industries, is because they have the technology where they're simply not required anymore. And that's a hard thing to address, because you can't really force companies to use technologies from the 1950s. And so that's going to be an ongoing struggle, I think, in terms of what does the government do about, job displacement because of new technology, because profit maximizing firms have a big incentive to adopt that technology. Now, in terms of the infrastructure plan, which would certainly benefit blue collar jobs, I'm all in favor of that, conditional on what they spend the money on actually having an impact on long-term economic growth. Because there's a lot of bridges to nowhere and roads to nowhere that you could build. But ideally, what this infrastructure plan should be is carefully targeted, carefully thought out, so that as you debt spend to do this infrastructure plan, what you're doing is you're spending money on projects that generate long-term economic growth, because that's going to help you pay for it, but it's also going to help you generate new jobs after the construction process is finished.
Thank you.
Okay, I've got several audience questions that I can go through. So Eric, if you have others, please pipe in. Otherwise, I'm going to keep going.
Keep rolling.
Okay, low wage earners at Walmart, McDonald's, et cetera, are SNAP, food stamps, and other government supported social support users. How can we address this in this pandemic situation?
Yeah, that's yeah, and actually, I had a chance to work a little bit at the very beginning of the pandemic. Um, I was asked to serve, just go to a few meetings of the Spokane County Emergency Response Group, and I had a chance to talk to the CEO of Second Harvest a few times about this situation. And there, in fact, has been a massive shift of people having to use those services. Um, and then, of course, you have the demand on federal services as well. Uh, again, I think there's not an easy solution to that. I mean, first off, those programs are necessary. We need to keep them in place, and we need to make sure that they're fully funded, because again, a lot of these folks, even if they go back to work, they're going to be, I'm worried, the chronically unemployed, even as they initially go back to work, because typically what you see is that um, an underemployment problem as you're coming out of a recession. And the deeper the recession, the bigger the underemployment problem. And that underemployment problem is people only being able to find part-time work when they need full-time work, right, to make ends meet. So you need to make sure that even though those people are working part-time, they're not completely cut off from those resources. You have to recognize there's an underemployment problem. You can also kind of help the situation by, I think, maybe even a third CARES Act. I think that might be necessary. But I definitely think that you need to keep these social programs in place, and you need to make sure that the underemployed, and maybe in some cases the fully employed who are working at low wages, are not automatically removed from these programs. And maybe that's what that means, is raising the income level that makes people qualify for those. I mean, in the sense of, you know, um, the current, and I have to clarify what I mean by that is, the current official poverty rates are really uh, out of date. And so you need to make sure that these programs have an adjusted income level so that you're not leaving working poor off the table from getting access to these programs. And quite frankly, uh, again, maybe, again, getting to the underlying problem, we really need to review and reestablish appropriate poverty line levels that weren't established in the 1950s or 1960s.
I'll just add a question to that discussion. Is there a sense of consensus among economists that this is essential, and how are we going to work into this with economic influence on the federal government?
Well, I always go back to this issue of low pay tends to be associated with lower skills. And so in addition to having, reviewing the safety net programs we've got, you know, reworking our poverty levels so they make more sense with the modern world. I also think we need to think about how we give access to these people to increase their skill level, because in the long run, that's really what's going to increase their possibilities in the labor market, is that if they have the ability to re-educate in some way and open up a greater possibility of employment that's less susceptible to low wages and instability when you have this kind of economic environment.
Yes.
And
Thank you.
again, that goes back to it, the problem of that's great in theory, but if they have to accumulate a bunch of debt to make that happen, that may be precluding a lot of them from making that leap.
Appreciate that. Thank you. I have another question. Given the economic impact of COVID, how do you explain the market's performance, and do you see this continuing?
Yeah, well, okay, so that's also a great question. So there's a couple things to remember about financial markets. One is there's a couple things going on here. One is that they're forward looking, and so asset prices tend to reflect people's expectations of where firm profits are going to go in the future. And so I think part of this reflects some optimism about where they think the economy is going to recover to in the long run, especially in the presence of a vaccine. But I also think that asset prices have definitely been helped by a pretty vigorous policy of low interest rates, accommodative monetary policy, and also fiscal policy, both of which have really kept the economy from a sliding to much lower levels, right? If these things had never been put into place. And so you have, forward-looking expectations. I think there's some optimism there, but you also have this combined effect of monetary and fiscal policy also, I think, adding some upward pressure on asset prices. I will say that one of the interesting things to watch during this crisis, so one thing has been the stock market has been surprisingly robust given all the problems we're having. But again, for the reasons I just described, I think that's what's behind it. But the other market that has held up surprisingly well, and you wouldn't have expected it in a deep recession, is the housing market. And not just, kind of across the US, for most part, the housing market has shown incredible resiliency. Usually with a recession of this depth, you would see a pretty good contraction in the housing market. So you not only have equity prices rising, again, forward-looking expectations, but also a benefit from fiscal and monetary policy. But you also have home prices rising. And in part, again, that's connected to monetary policy, ultra low interest rates, but also fiscal policy that's helping to keep the economy from sinking lower. And, it's been surprisingly resilient. So you have equity prices and real estate prices, in particular housing, doing pretty well. But I would point out, going back to the whole thing of income inequality, you know, uh, the people most likely getting the benefit of rising home prices and rising equity prices are going to be those higher income households.
Okay. In the long term, is some form of guaranteed annual income an answer to the increasing displacement of labor by technology?
You know, it's interesting. I'm a big science fiction fan, and that whole issue of a guaranteed income has been in. It's been in science fiction books for a long time because, of course, science fiction deals with this issue of, what happens if you have a level of technical innovation where, everything can be automated or most things can be automated. My personal view is that's an issue that's still worth exploring. Uh, it's worth watching experiments. We do see experiments starting to occur in different places in the country, but also in the world, where you have some guaranteed income experiments going on. I mean, I'm not sure it's the final answer, but it's certainly something worth exploring, especially if we get a big push in technical innovation where that displacement effect is very large. I mean, I think realistically, you can't have a large group of your population with no means to take care of itself. And so I think it's worth thinking about, it's worth theorizing about, and it's worth experimenting with. Is it the end all be all? I don't believe in silver bullets necessarily in economics, but again, you know, there's no harm in thinking about it and experimenting with it.
Another question. What is the COVID impact on the healthcare industry GDP, as well as on the long-term financial impact on uninsured and underinsured?
Well, that's a great question. And so, I think what the pandemic has shown is what I've always suspected about healthcare. And I've said this before in public forums, so it's never gotten me chased down yet. But you know, in America, you have many, many people who believe that healthcare is not a right as enumerated in the Bill of Rights or the Constitution. The problem is when we get sick, we virtually all behave as if it is a right. And I think what the pandemic has shown is that's absolutely true. And so I think the pandemic is going to show that regardless of people's personal political views about, whether or not healthcare is a right, clearly we behave as if it is. And so my guess is it just continues to put upward pressure on the demand for healthcare, and healthcare as an increasing share of economic activity in the United States. It also continues to make the case for, I think, some kind of like the Affordable Care Act. I mean, it's sort of at this point, if you look at the demand for healthcare that occurs in this kind of situation, it's kind of hard to argue that the Affordable Care Act is a bad idea if you can increase insurance coverage, right? But definitely it has increased the demand for healthcare. It's increased the people accessing healthcare, and I just think that's some of that will diminish as we get the pandemic under control. But I think what it does is essentially just continues to increase that expectation in the public through behavior that they can just get the health care they need when they want it. I will also say, though, that the other thing that's going to drive healthcare demand going forward, a couple of things. One, we don't know the long-term health problems associated with contracting COVID. That could keep healthcare, the pressure up for healthcare even after we get the actual infections under control. The other thing is we have an aging population in the United States. That's naturally going to increase the demand for healthcare anyway. So I just see no abatement in the demand for healthcare in the U.S., whether or not you have insurance.
How much, if anything, does the tax structure impact the inequality factor?
Well, it depends. We tend to focus a lot on the federal taxation, the federal tax system, which is still a progressive, so personal taxes at the federal level is still progressive. The more you make, the more your tax rate goes up. The bigger issue, I think, with inequality and taxation is looking at what's happening at the state level, state and local. I mean, if you really want to understand the impact of taxation on inequality, you have to look at all levels of taxation and how those taxes are being collected. And so I think of example of Washington State, what legislature is going back and reviewing and updating the tax study that was headed by Bill Gates Sr. in the early 2000s. They're in the process of updating that work. And, it's pretty clear that, it was highly regressive back then, our state tax system, it's still highly regressive now. And so again, if you're going to understand the inequality impacts, you have to look at those local and state taxation structures, not just the federal.
How about corporate taxes?
Corporate taxes is a tough one. Again, I tended to be kind of in support of that tax adjustment. I mean, just as a professional economist, because we had a lot of corporations essentially hiding activity outside of the country because other developed countries had much more advantageous tax rates for companies. And so I mean, there's nothing wrong with revisiting how the corporate tax rate is structured and what the level is. But I think when you talk about corporate taxation, you always have to look at it in terms of how are other people taxing outside of the U.S., given the fact that capital and so forth is pretty mobile.
Another question from the audience. Scandinavian countries in particular invest in college education because the future return in income tax more than justifies the expense. Your chart seems to bear that out as well, and our own history with the early GI Bill would support it. So what is the basis to argue against it?
Well, I mean, it's a good question. I mean, I would say that if you're going to go to so for example, I worked, in the Czech Republic for a while, and they had a system, their university system is heavily oriented towards, low costs and government support. But in order to allocate space, they have a finite amount of space in their universities. You have to have a very different system. So here it's sort of, can you pay the money to go? And there is, can you pass the exams to go? And so if you're going to switch to a system where it's a more European style, where you have heavier subsidies to support higher ed rather than tuition, then you have to rethink about how you allocate space. And typically in European countries, that's through pretty vigorous exams. So you're talking about fundamentally changing the way people can enter and matriculate into higher ed. And the question is, are we okay with that? I mean, that's a debate that you're going to have nationally. And I would also point out, in those countries, higher ed is structured very differently, in the sense that they're basically not oriented towards near professional sports. I mean, I'm not being funny. I mean, so when I worked with the universities in the Czech Republic, their entire structure was very much focused on just educating, right? There was many fewer amenities to augment the college experience, including athletics. And so we would also have to think about fundamentally restructuring the activities of public higher education if we want to go to that kind of model. And the question is, are people going to support that?
Kenny, I have one. Kind of pulling it all together. There's a lot of people concerned about our deficits right now. The the pandemic response. We're borrowing a lot of money. How concerned should we be? And what's ultimately the way out of it? I mean, at the end of the day, a couple of years from now, let's say all goes well. What does that mean to tax policy? I mean, are we looking at austerity? I mean, how concerned should we be about our debt?
Well, I mean, my personal feeling is I don't. It doesn't keep me up at night. Let me put it that way. Because the alternative to not building up this debt is to have a much deeper, much more severe recession and recovery time. And I don't think that's what we want. And I think we learned from the Great Depression, the 1930s, is that if you just allow things to go into free fall, it can be an absolute catastrophe. So my view is it's the right thing to do right now, because the alternative means something deeper and much nastier. And I don't think we want to go back to that kind of 1930s experience again. So in the long run, the way out of this is going to be a combination, you hope, of policies that, return us or encourage a certain amount of economic growth, but maybe also some taxation adjustments that are going to have to occur. But that being said, maybe our goal shouldn't be an absolutely 100% balanced budget. Maybe what we want over time is just a budget deficit that's there, not particularly large, and sustainable. Maybe that's okay. I mean, that the evidence suggests that financial markets are okay with that. And so again, the way we're going to get to that point is probably going to be a combination of economic growth, but probably some tax increases at some point.
Right.
Oh, go ahead.
And as long as interest rates are low, all's well.
Well, I'll be honest with you. I don't really see. I mean, I think that central banks are in a position, as long as inflation remains pretty muted, I think they can leave them low for quite a while. And I would also point out that some other research that was done really this summer, again, from the National Bureau of Economic Research, you had some people look at what happened to European real, meaning inflation adjusted interest rates following pandemics in the past, right? And it turns out that if you look at that, it's not unusual when you have a pandemic event that slows economic activity, that interest rates remain unusually low for a long period of time, right? My sense is the Fed, not just the U.S. central bank, but many central banks are fairly comfortable with this idea that we're just going to be in a prolonged period of fairly low, both nominal and real interest rates. I mean, excluding the prospect of some, out of control inflation.
Thank you. Kenny, do we have more audience questions?
I believe that they have been answered more or less in these discussions.
Those are some complicated. I'm sure some people are probably wondering about my answers. Those are great questions and they're fairly complicated. So hopefully I got to them as best I could. People can email me if they're not comfortable with the answer.
Right.
So that's probably it, unless I see a couple more show up on the Q&A.
Right. Well, Dr. Forsyth, we really appreciate you being with us again. Very generous of you to share your time with PEG and our members again. I think I want to talk to you at some point about this. I want to have an epic forum on the college education problem from every angle. That might take a few of them.
Well, I'll just, on that issue of college, I will say that pandemic has definitely highlighted some real structural problems with higher ed. No question about it. And, I tend to always talk about it in terms of public higher ed, because, that's where you tend to have more, public monies going to. And, the privates have, I think, to me, philosophically, the privates have more leeway in what they do. But I really sort of think the pandemic, to me, has more strongly put forward kind of the benefits and problems with higher ed that we really shouldn't delay talking about anymore. But we'll see what happens.
That's great. Well, thanks again, and thanks for all for attending. If you want more information on PEG or how to be a member, www.pegnow.org. And thanks for coming again. Take care.
Good evening, everybody.
Good night. Good night. Thank you, sir.
Bet.